California Public Utility Commission is voting on applications from Cruise and Waymo to add more vehicles and operate autonomously 24/7 throughout all of San Francisco. The decision of which could have a huge impact on the industry and the experience we all have on the roadways. Let's get to Phil LeBeau with the details. What do we know so far, Phil?
Well, the meeting has just begun, Kelly, and I think this is towards the bottom of the agenda, at least the last time we checked, so it may be a while until we get a final decision from the CPUC. But let's recap what you said in terms of what this vote is, because I've seen a number of people say, well, this is going to allow them to put autonomous vehicles all over the state of California. No, this is strictly about 24/7 service within San Francisco and other things like they might be able to add split fare routes in the future.
When it comes to making EVs, Tesla is far ahead of others in the industry. The car company has an edge on reaching monopoly over the long term and will likely be making EVs in a profitable way. We're aware that investors may need right now assurance and reassurance on Tesla's long-term potential and its capacity to be so much more in the future. But if you take a closer look at Tesla, this truth is clearly open for all to see. Even Gary Black and Cathie Wood reiterated this in recent interviews where they emphasized the growth of Tesla and its profitability that lies ahead. We're not going to tell you that Tesla won't have any problems going forward. Of course it will. But what matters is how Tesla navigates through the hurdles and achieves its goal towards sustainability.
Well, as you know, we have a 5-year investment time horizon, and we do think the cycle for autos is going to get tougher in here generally. But we think just like last year when electric vehicles were up 69% or 65%, something like that, and gas-powered vehicles down 7% globally, we think we're going to continue to see that share shift accelerate because electric vehicle prices are going to follow their costs down in a way that gas-powered cars cannot. So we think that electric vehicles will be less expensive, and they are better cars than gas-powered vehicles. So we think they're going to take tremendous share. And even if the auto market relapses in here, which we think it could, we don't think electric vehicles will relapse. So we think the 1.8 million for this year, which was Elon said 1.8 to 2 million, they're going to have some shutdowns in the third quarter for maintenance and upgrades, and so he lowered his expectation to the lower end of that range. I think he likes to lower expectations and then beat, so I wouldn't be surprised if it's higher than that.
Musk has once said that Tesla plans to hit a 50% growth rate in the future. In 2020, the car company stated that over a multi-year horizon, it expects to achieve 50% average annual growth in vehicle deliveries. It also further stated that the growth rate will depend on its equipment capacity, factory uptime, operational efficiency, and the capacity and stability of the supply chain. Now, several researchers have been conducted on this proposed plan, and many have proven that Tesla's 50% growth target is actually very possible. Hey guys, welcome back to Tesla Tomorrow. Several analysts have noted that Tesla's dominance and the big future ahead of it is actually looking pretty good. Two of such analysts are Gary Black and Cathie Wood, who've made these latest bullish calls on Tesla. These two analysts have made very interesting comments about Tesla, and we think every Tesla investor needs to get a hold of these details. Before now, Cathie Wood has said that in a situation of serious economic backdrop, only companies with a competitive edge on innovation can thrive in conditions of serious economic backdrop. We have reason to believe that Tesla is one of those companies that Wood is referring to, because despite what happened with the automaker last year, Tesla is still performing incredibly well. Now let's dive into Cathie Wood's latest comment about Tesla. But before we do, if you like this type of content, hit the like button, subscribe, and turn on notifications to keep up to date on everything going on with Tesla. Cathie Wood is a long-term Tesla investor that has continuously reaffirmed her bullishness on the company. This is what Cathie Wood thinks. First, there will be a huge shift from ICE to electric vehicles. And second, this shift will greatly benefit Tesla. You see, the world's collective focus on environmental sustainability has ushered in a new era of transportation. EVs offer a clearer alternative, which are very clean for the environment when compared to traditional ICE vehicles. And with rising concerns over climate change and air pollution, the demand for greener options is intensifying. The demand and sales of electric cars are already increasing and are poised to surpass those of their ICE counterparts. The reduced carbon footprint and lower emissions of EVs align with the global push for cleaner air and a healthier planet. And as awareness about the environmental impact of traditional gasoline-powered vehicles grows, consumers are going to make more informed choices. But what about the technological advancements? These advancements have transformed EVs from niche vehicles into mainstream contenders, and innovations in battery tech, charging infrastructure, and electric drivetrains have all overcome some of the early hurdles, making EVs more practical and accessible. Also, while the upfront cost of an EV might still be higher than that of an ICE vehicle, the long-term ownership can be significantly lower. EVs have fewer moving parts, which translates to lower maintenance costs and reduced reliance on volatile fossil fuel prices. For Gary Black, the Tesla picture is even bigger. The Tesla analyst disclosed several catalysts for Tesla stock in the near future, including the launch of the Cybertruck, the $7,500 EV tax credit, and the Model 3 upgrade, and even Tesla's expected cheaper vehicle. Elon Musk has confirmed that Tesla is looking to make a lower-priced car, a China-designed $20,000 to $35,000 smaller EV that will reduce production costs and make electric cars cheaper. The goal of this platform is to reduce their production costs by 50% as compared to a Model 3 or Y. And this also includes less need for labor and space within the factory facilities. With this new platform, Tesla intends to manufacture a greater number of cars than all other Tesla vehicles together. This could mean manufacturing more than 1 million EV units a year of its most affordable electric car. There are even plans for a gigafactory and how to make it autonomous. And that would enable it to build EVs that can drive up to 50 to 60 hours instead of 10 to 12 hours a week. But this increase in car production means that Tesla will have to take control over its raw material supply. The rise of EVs has caused many automakers to become more involved in the mining industry to secure raw materials needed to manufacture batteries, and Tesla is one of them. The automaker will be shaking off its lithium dependency and earning federal tax credits within a refinery in Robstown, Texas. This refinery is Tesla's latest expansion into Texas, and it began when the company moved its headquarters to the state of California in 2021. The automaker invested nearly $6 billion into its Austin Gigafactory last year, and will now be investing $375 million to build a new facility. This facility will make Tesla the only big American car company that will produce its own lithium, and will also make it easier to fulfill the Made in USA subsidy requirements for getting the billions in tax credits doled out under the auspices of the Inflation Reduction Act. The refinery will push Tesla outside of its core focus of building automobiles and into the complex area of lithium refining and processing, a step which Musk has said is necessary if the car company wants to meet its ambitious EV target sales. Elon Musk described refining lithium as a way to ease supply chain bottlenecks of the key materials used in lithium-ion batteries. According to him, even if there was a great supplier who's better than Tesla, or even where the economics of comparative advantage suggests that Tesla should be used as that supplier, it will, and then Tesla will use its resources to do something else that will be more productive. So you see, irrespective of how it does it, Tesla is focused on growth, and this growth will subsequently be reflected in its stock price over time. But what do you think? Let us know down below. And for more exciting updates on Tesla, go ahead and click on this next video on your screen. See you there.